Welcome back to Investing Talk Podcast. Today, we're going to be looking at Douglas Emmett,
Okay.
ticker symbol DEI, as of March 19, 2025. And we've got a lot of information here, actually, with an analysis of the stock market trends,
Right.
technical analysis of DEI,
Yeah.
and recent news that might be impacting the company. So really, what we're trying to do is take all this stuff and kind of boil it down into the stuff that really matters.
Absolutely. Yeah, that's our mission.
Right.
I think that's a great way to put it. So, it's interesting because the stock market in early 2025, it's been a little bit of a roller coaster.
Oh, yeah.
Right?
Definitely volatile.
Driven by all sorts of different things, macroeconomic factors. We've got U.S. tariff policies under President Trump.
Right.
We've got fluctuating treasury yields.
Yeah.
All of this creates kind of an uncertain environment.
Yeah.
But the interesting thing is that U.S. equities, they've shown some resilience.
They have.
They're hanging in there.
Right.
So this is the background, really, against which we need to understand Douglas Emmett, which is a REIT.
Real estate investment trust.
Exactly, a real estate investment trust.
Yeah.
And their focus is primarily on office and apartment buildings in those really desirable coastal markets like Los Angeles and Honolulu.
Oh, nice.
Yeah.
Yeah. So let's, jump into DEI and kind of look at their recent performance.
Okay, sounds good.
It looks like they declared a quarterly cash dividend
They did.
of 19 cents per share,
Yeah.
which comes out to 76 cents annualized,
Right.
payable April 15, 2025.
Mm-hmm.
So that suggests, at least consistent cash flow.
It does, yeah. And I think that's what we look for
Right.
in a REIT, right?
So
That stable dividend, it's often a positive indicator.
Right.
And it's interesting because around the same time, on March 17, Jefferies initiated coverage on DEI with a hold rating and a price target of $16.
Okay.
So, that basically signals a neutral outlook from their perspective.
Kind of the middle of the road.
Yeah, for the near term.
Right.
This hold rating coupled with the $16 price target, it really suggests that they see DEI's price. It's not going to move dramatically in the short term.
Okay.
And this could suggest that they see the current valuations as being fair, given, some of the near-term headwinds.
Like what?
Things like potential refinancing costs and maybe the delayed impact of their development projects. We'll probably touch on those a little bit later.
Yeah, that's interesting. So we've got kind of this, neutral outlook from Jefferies.
Yeah.
But I'm also seeing that there's a Seeking Alpha post
Okay.
from March 16 that had a more optimistic view.
Okay.
They actually labeled DEI a buy
A buy.
if the U.S. avoids a recession.
Okay.
So that paints kind of a mixed picture, doesn't it?
It does. It does. And Seeking Alpha is really emphasizing, the potential for growth if the economy stays, looking good.
If things stay positive.
Yeah. So, we don't have specific Q1 2025 earnings
Right.
details.
Doesn't need this material.
Right. We don't have those yet.
Right.
But the fact that they're maintaining this dividend,
Right.
along with these analyst ratings, gives us some insight into how they're doing.
Sure.
I think it's also important to think about, the historical context for REITs. REITs, they tend to perform well when interest rates are low.
Right.
And there's a strong demand for rentals.
Okay.
However, we're in a situation right now where U.S. Treasury yields are rising.
Right.
And the 10-year Treasury was at 4.22%
Yeah.
around March 10th. And so this could put some pressure on their valuations.
Makes sense.
Yeah.
So looking at some of the emerging patterns here,
Okay.
it seems like the REIT sector as a whole is really sensitive to interest rates.
Yeah, it is. That's a really key observation.
Okay.
As you know, as Treasury yields rise, and we have seen wider corporate bond spreads, it indicates that there's a level of caution among investors. However, DEI's consistent dividend might signal that there's some underlying strength that could help them, kind of navigate this whole environment.
Okay.
And I think what's notable here is that DEI might have an advantage because of where they're located.
Okay.
So, we're saying that the REIT sector is facing some headwinds with these rising rates, but what makes DEI different?
Right.
And I think the fact that they're concentrated in these strong coastal markets is a key factor here.
Those coastal markets you're talking about, Los Angeles.
Los Angeles.
Honolulu.
Honolulu, exactly.
Okay. Historically, those have had strong demand, right?
They have, yeah, historical.
Both office and apartment space.
Yeah, and that could provide some stability for DEI, potentially offsetting, some of those broader concerns that we're seeing in commercial real estate.
That's right.
The shift to remote work and the fears of a recession.
Interesting.
So DEI's specific market focus, I think, could be a significant differentiator here.
Yeah, makes sense. Now, we also saw that First Eagle Investment Management reduced their stake in DEI.
It did.
By about 2.6%.
Yeah.
In the fourth quarter of 2024, and this was reported around March 15, 2025. Any thoughts on why they would do that?
It's tough to say without having more information.
Right.
But, it could be a case of profit taking.
Okay.
Especially given the market uncertainty we've talked about.
Yep.
Or it could just be, a reallocation.
Right.
Based on their, broader investment strategy.
Right.
But I think it is important to point out that this was a relatively small reduction in their overall holding.
Okay.
Okay.
So how about DEI's performance and the broader market? How are those linked?
Well, they could certainly show some correlation with overall market sentiment, as indicated by, movements in the S&P 500. However, their dividend yield, which appears to be somewhere in the 4 to 5% range, could offer some downside protection compared to the broader equity market. And this aligns with a trend we've been seeing, where investors are focusing more on income-generating assets in this current environment. So for, someone like you, who's following this market, this downside protection offered by that dividend could be, a pretty significant factor to think about.
So let's move on to the technical analysis.
Right.
Based on the information, following their Q4 2024 earnings, which was back on February 4, they showed a slight beat on Okathon expectations and a small price increase. It sounds like on March 19th, the stock price was probably hovering near that $16 mark.
That aligns with the analyst target that we talked about, FFO.
Funds from operations.
Funds from operations, is a key metric for REITs because it reflects their cash flow from operations. So the fact that they had a slight beat suggests that their operations were doing a bit better than expected in terms of cash generation.
Okay.
In terms of trading activity, the typical daily volume for DEI seems to be around 1 to 2 million shares.
Okay.
If we look at moving averages, the 50-day moving average was probably somewhere between $15.50 and $16.
Okay.
And the 200-day moving average was somewhere between $14.50 and $15. This 50-day moving average, it essentially smooths out the daily price fluctuations over the last 50 trading days, and it being just above the 200-day average, which looks at a longer trend, like 6 to 9 months, often suggests that there's a mild upward momentum in the stock price. However, the closeness of these averages indicates that this trend isn't very strong right now.
Right. So how about momentum?
Okay.
The RSI.
Yeah, based on the, stable price action we've been discussing, the RSI was probably somewhere in the 50 to 60 range, which generally means neutral momentum.
So not overbought.
Right.
Not overbought.
Not oversold.
Not oversold.
Okay.
Got him.
What are some key levels to watch?
Key support appears to be around $15.50.
And resistance seems to be somewhere between $17 and $18. Taking all of this together, the technical analysis seems to point towards a hold recommendation, suggesting that we really need to see some stronger catalysts to see a significant move in either direction.
Okay, that makes sense. And that ties in with some of the recent news and developments. The hold rating from Jefferies on March 17th with that $16 target was specifically due to, expectations of dilutive refinancing.
Right.
And a bit of a wait for earnings growth from their projects.
Yeah.
Potentially not materializing until 2028.
Yeah, they're likely anticipating that DEI might issue more shares or take on more debt in a way that could reduce the earnings per share, hence the term dilutive.
Right.
This is a key concern for investors.
Yeah.
Because it can impact future profitability on a per-share basis.
Yeah.
The consistent dividend announcement in late February offers support for the stock, especially for those who are looking for income.
Right.
However, the Q4 2024 earnings report, while it did show a slight revenue beat, did reveal a significant miss on earnings per share, which represents the company's profit allocated to each outstanding share of common stock. And a significant miss here can be concerning because it indicates lower than expected profitability on a per-share basis. We also saw that full-year FFO was down and revenue decreased year over year. And this likely had a dampening effect on the stock.
Yeah, I bet. And then that reduction in First Eagle stake.
Right, exactly.
In Q4 could have added to that selling pressure.
It could have.
It seems like there's a lot of different things going on here.
There are a lot of factors at play, yeah. The broader market context of rising treasury yields is definitely, a challenge for REITs.
Right.
But as we've said, DEI's concentration in those strong coastal markets could provide some counterweight to that.
Okay.
That buy rating from Seeking Alpha, contingent on avoiding a recession, also adds, an interesting layer of potential optimism.
It does.
Even if it is conditional. And then there was also that interesting tidbit about speculation from Piper Sandler back in January, suggesting that DEI could see a long-term benefit from the Los Angeles wildfire rebuilding efforts. Now, that's not an immediate driver,
right,
but it is something to consider for the future.
Yeah, for sure.
It highlights the fact that there could be some unforeseen positive catalysts down the road.
Okay.
So when we consider potential investment angles, DEI could be seen as a defensive income investment, particularly if interest rates stabilize or even decline.
Okay. It also sounds like it could be a really good opportunity if the U.S. can avoid a recession, allowing DEI to leverage its position as a quality REIT in a recovering market.
That's right. And, given the current environment where there's this caution towards REITs, DEI's stable dividend, and their premium assets, might make it a contrarian investment for some.
But of course, we got to consider the risks.
Of course.
Sustained high interest rates seem like a primary concern.
Absolutely.
For REIT valuation.
And then there's also the overall economic uncertainty, including those tariff policies and the potential for government shutdowns. All of that could weaken demand for rentals.
Yeah, for sure.
Impacting their bottom line. And the fact that we don't have that Q1 2025 earnings data yet adds another layer of uncertainty.
To the immediate outlook.
To the immediate outlook, exactly.
So considering all of this information, it seems like Douglas Emmett is in a period of stability, but within, kind of a turbulent market.
Yeah, I think that's a good way to put it.
The consistent dividend, it's offering that income stream.
Yeah.
And their focus on those coastal markets does seem to be providing some resilience.
Yeah.
But we got to keep in mind those rising interest rates and the recent earnings challenges.
There are definitely factors to consider.
It sounds like the general consensus is neutral in the short term.
Yeah.
With the potential for upside really hinging on broader economic conditions.
I think that's right.
For someone like you who's following this market, it seems like you really have to weigh that reliable income from the dividend against those potential headwinds from the economy and the interest rate environment.
Yeah, I think that's a good summary. This analysis, of course, is based on the information available up to March 19, 2025.
Right.
It's just a snapshot.
Of course.
And, anyone who is considering an investment should do their own thorough research.
Absolutely. We always say that, so we hope that this is giving you some valuable clarity. And if you found this helpful, please subscribe, like, and comment to let us know what you'd like us to cover in the future.
Sounds good.